I'm Mark Tracy, Professor of Sustainable Finance and Investing at IBIS, Brown University's Institute for Environment and Society. It's my pleasure to welcome you to Values at Risk, Nature, Climate, and the Systemic Risk to Our Economic Future. At IBIS, we are accelerating solutions to the complex climate and sustainability challenges of our time. Part of the IBIS strategic plan is to engage for impact and serve as a hub for the exchange of information from trusted sources. And today we have a great group of panelists to do just that. It is my great pleasure to introduce our moderator, Ricardo Bayon. Ricardo has been an early advocate for the teaching of sustainable finance at IBIS, helping to demonstrate student demand for the topic through his class, Finance and the Environment. Ricardo is also partner and founder of Encourage Capital. Ricardo?
Hi there, and thanks everyone for joining. As Mark said, we have a really great panel here to talk to us about an issue that I don't think gets nearly enough attention. And that's the issue of risk into the financial system, but also risk more generally, and climate risk and nature risk in particular. We've talked a lot over the years about environmental externalities, and we've talked a lot about the need to pay for ecosystem services and issues like that. I don't think we've really wrapped our minds around one of the major types of externalities that we're facing, and that's the risk externality, the risk that our changing climate and our changing ecosystems pose to our everyday lives. And yes, it comes via ecosystem services, it comes via the provision of clean air, clean water, it comes via the provision of pollination services to agriculture, it also comes via the provision of raw materials for every aspect of our industries worldwide. And it comes, as we've seen most recently, in the form of climate risk, increased storms, increased wildfires, things like that are affecting our financial system in huge ways. And we will hear today about some of those risks, about how the financial system does or does not take those risks into account, and about what we might be able to do to change that and to help the financial system and to help us wrap our minds around risk. Before I ask all the panelists to introduce themselves and then we jump into the discussion, I'll just say that, if you look back at history of finance and the history of business, this issue of risk has been kind of a defining topic over the last 10, 15 years. Financial institutions have tried to wrap their mind around how to measure, how to monitor, and how to price and how to manage risk more generally. What they think about risk is generally standard financial risk. So it's things like risk of repayment of debts. Will the debt be repaid? What is the risk that a business will go out of business? What are the risks they'll get or not get? The revenues they're supposed to get. That's the kind of risk that they've focused on. But I think they've missed this huge area of nature and climate risk. And it's going to be one that we're going to see more and more of. And it's going to be one that's going to affect us in lots of different ways. And so today, I think we can dig a little deeper into those, figure out what they are, what they look like, how they might affect business as a whole, and just as importantly, how they may affect underserved communities. So I'm going to ask folks to introduce themselves. We have a great panel. I'll start in reverse order of the questions. So Claire, if you could go first.
I'd be happy to. Thank you, Ricardo. It's good to be here. I'm Claire Kramer Mills. I'm a director in the community development team at the Federal Reserve Bank of New York.
You want to give your disclaimer, because it wouldn't be a meeting without
I will give my disclaimer, which is that the views that I will express are my own and do not necessarily reflect those of the Federal Reserve Bank of New York or the Federal Reserve System. Thanks.
Perfect. Awesome. Check that box. Okay, Raviv, you want to go next?
Yes. Hey, Ricardo. Thanks for having me. Great meeting everyone here on the panel. I'm Raviv Turner. I'm a founding member of the Nature Tech Collective that brings together over 200 members of companies that measure technologies together with financial institutions, insurance companies, and corporations to really understand and mitigate nature risk. I'm also a founding partner in the Nature X Venture Studio. We build and invest in nature technologies. And I also sit on the TNFD Nature Data Working Group that is working together with Emily and the team to think about a public nature data utility for the use of governments and institutions to close the gap on nature data. And hopefully I don't need any disclaimers. Am I clear?
You might, but we'll find out. Your lawyers will tell us at some point. Thanks, Raviv. As you'll see, we had an unfortunate last minute event that Tony had to attend. So Tony Goldner will not be with us today, but he works very closely with Emily. Emily, you want to just give your intro?
Thanks, Ricardo. Yeah, it's a pleasure to be here. I work as Tony Goldner as the executive director. He's very sad to miss this. I work closely with him as the technical director in the secretariat that supports the Taskforce on nature-related financial disclosures, goes by the acronym of TNFD, which I will talk about during the session. I've worked on nature for 20 years. Before working with TNFD, I was in the UK government for a few years and worked on something called the Dasgupta Review on the economics of biodiversity, which is kind of a seminal report looking at this issue akin to the Stern Review on the economics of climate change.
Thanks. Pleasure to have you, Emily. Carter, you want to go next?
Sure. Thanks, Ricardo. And thanks for the invitation to participate in this. I'm Carter Ingram. I'm a managing director with Pollination. We're a climate change and nature investment and advisory firm and a law firm and a foundation. We're doing a lot of things to try to catalyze the transition across finance, communities, and policy. So really excited to be here. We've been involved in helping companies pilot the TNFD. So really excited about this conversation. My background is my graduate work, my PhD, everything was in biodiversity and landscape ecology. And then I've been for the last 10 years working in the corporate and investment space on natural capital and nature related issues. So excited to be here.
Maybe you can kick us off as we think about nature and climate risk. You know, I think a lot of people have come to understand climate risk to some degree, largely through, you know, increased hurricanes, wildfires, some of the things that have afflicted the globe over the last few years. In particular, you know, this year has seen a tremendous impact of some of these storms in the US, in Florida, and North Carolina. Fire seasons continue to get worse in the US, but not just the US, all over the world. So I think people are beginning to understand what we mean when we say climate risk through natural disasters, but that's just a tiny subset of climate risk. And that doesn't necessarily, it's related to nature risk, but doesn't necessarily incorporate all the issues around nature risk. I wonder if you could tell us a little bit about how you see nature risk, what are the issues that we're thinking about, how it relates to climate risk, and maybe talk a little bit about how you see our global financial and economic system dealing with or not dealing with these issues appropriately.
Yeah, there's a lot in that question. So I'll start by saying, you know, I think more than ever, there's a recognition that nature is incredibly valuable to the global economy. In recent estimates by PwC and the World Economic Forum estimate that over 50% of our global economy is highly or moderately dependent on nature. Some people push back on that and say all of our economy is highly dependent on nature, but nevertheless, our economy is highly dependent on nature. And there's some sectors that are more dependent on nature than others. If you think about forestry, real estate, agriculture, for example. And so, you know, there's this growing awareness of how important nature is. And I think one of the things we're starting to see, unfortunately, is that despite that growing awareness of the important economic and financial value of nature, we are losing nature faster than we ever have, as the IPBES Global Assessment recently highlighted, and the Living Planet report by WWF that came out recently, you know, highlighted that we are losing species at increasingly fast rates, way higher than the natural rates in the natural world. And so with that is we are seeing tremendous risks that are being posed to our economic and financial systems. I mean, just to give you an example, we think about the fact that over 75% of global crops are dependent on animal pollinators. and about $577 billion of global crop output is now at risk because of the loss of wild pollinators. So, we're starting to see very tangible examples. One area that I've been working on with some colleagues is on the role that coastal ecosystems can play in risk reduction. A recent study that came out from the University of California, Santa Cruz estimated that globally, mangroves are providing $855 billion in flood protection services worldwide. And so, we're starting to really understand the value of nature and what happens when we lose nature and the risk that poses. One thing, though, that I don't think we quite yet have a great understanding of, and groups like the TNFD are helping to shed more light on this, is how are businesses, individual businesses, affected by loss of nature, and how does that create risk for the business, but what are also the opportunities that can emerge from more sustainably managing and restoring nature. And so I think increasingly businesses are starting to understand, try with guidance from TNFD, understand and identify what their impacts and dependencies on nature are, which leads to a suite of different types of risks. But the world benchmarking, there's a world benchmarking assessment recently, and they scanned over 800 companies and found that only about 5% of them understand what their impacts on nature are, and only about 1% understand what their dependencies on nature are. So there's a huge blind spot there with respect to companies' understanding of how they might be, one, dependent on nature and how that could result in nature-related risks that then translate into a suite of different types of business risks, transition risks, physical risks, and Emily will talk about those in a minute. We've been doing a lot of work with companies to try to understand what those impacts and dependencies are, how they manifest in different types of risks and opportunities, and what you can do about them. And one thing we're seeing is when we think about some of the aspects of nature that we're losing that are the most valuable, what many people have referred to as regulating services, which we know have been the aspects of nature that we're losing more rapidly than some of the other services. And those include things like regulation of climate, regulation of water quality and quantity, the regulation of disasters, for example. A lot of times managing those ecosystem services, conserving and restoring them, doesn't fall within the remit of any one single company or institution. So we really need collective action at landscape scales to manage some of those benefits that we get from nature, that if we lose those, they create significant economic risks and risk to businesses. So that's something we're working on with companies, for example, across large landscapes, to figure out how do we bring multiple businesses together to manage the risks of water loss that can be, in some cases, mediated by regenerative agriculture practices and restoration of wetlands, for example. But that requires multiple companies working together, which is not something I think we're seeing a lot of yet. Maybe I'll pause there. I know that was a lot.
No, that's great, Carter. I think, you mentioned pollination, and just to give an example, I think few people realize that every year in spring, the almond farmers of California import many of the country's bees by train, truck, and other mode. So they ship them from as far afield as the East Coast to California to provide those pollination services. Why? Because many of the natural pollinators that would have been in California are not there, and because almonds are sometimes grown in such extensive areas with not enough natural systems around to provide the pollination. So that's a several $billion cost annually to almond farmers. Now imagine if all of agriculture had to pay for its pollination. How big a hit would that be to the finances? And I think you mentioned the need of many companies to collaborate, but at the very least, I think they should begin to understand how big a financial hit this could be. So even if you don't, care about nature for the reasons that many conservationists do, from a financial perspective, This is like saying there's smooth sailing without seeing a major storm coming your way or a major iceberg in your path. And I think what's interesting about TNFD, and maybe Emily, you can talk to us a little bit about what TNFD is and what it does, is that it's beginning to sort of, remove the fog to reveal the iceberg that's ahead of us, to kill that metaphor. Emily, you tell us a bit about TNFD and what you see going forward?
I love the metaphor. I'm going to have that image with me now in all my work. Yeah, so I guess building from what Carter laid out, I think there is increasing recognition. It's not universal, but within both corporate and, importantly, the financial sector of these risks. And so it's shifting out of where it was previously, kind of a bit of a silo, maybe a CSR or corporate or social responsibility issue, into emerging as climate, as you mentioned, Ricardo, has started to do now, realizing there's a bigger frame of which climate is a part, and nature loss and halting and reversing that rapid, historically unprecedented decline is a central and strategic risk management issue in its own right, and also critical for addressing climate change. So you can't think about climate without nature. That's sort of the gateway in if you've been thinking about climate, but then you realize in its own right, we're outside of the safe space of at least 6, maybe 7 now of the 9 planetary boundaries. So I think that bigger frame has come. And so TNFD was an initiative recognizing, okay, that this is a serious risk issue, but it's also, I think, through the WEF report showed it's also the one that business is least well equipped to manage. And business and financial institutions both have not had the tools, if you like, or what they need to be able to identify and assess these risks and manage them effectively, as well as disclose them, using disclosure as a mechanism for building accountability and transparency and driving finance into the businesses that are managing it well. So we, for those on the call who know about TCFD, the Taskforce for Climate-Related Financial Disclosures, they set the precedent, if you like. We follow, to continue our analogy, in their wake. So back in 2017, they published a set of recommendations for disclosure around climate risks, and that has now mandatory in, I think, at least 14 jurisdictions. So that's helped on the climate path. And so the TNFD was established a few years later. We were formally established in 2021 to do the same thing for nature-related issues, risks and opportunities. And so that's what we've done. I mean, at the heart of what we've produced is built from TCFD. It's a set of disclosure recommendations, and we purposefully built from their 11 disclosures to enable that integrated approach to think about climate and nature in a connected way, and also build from what people already understand. But we've actually gone quite a lot further than TCFD in creating guidance, because many of these business and financial institutions are starting to realize this is important, but saying we humble, we don't know much about the topic. So we've also created quite a large package of guidance that helps organizations internally to identify and assess the issues and think them through. And one of the things that's really struck me in the last few months, indeed, at some of the events I was with Carter in Colombia recently, is the recognition of the language system. So building from what you said, Carter, about definitions. I mean, and none of this was starting from scratch. It was building from things that have been in the works for many years, but we brought together like a common language system, definitions, glossary, way of talking about the issues, just like has emerged from climate. So Carter mentioned different types of risk and this idea of physical and transition risk that's emerged from climate. So we've added that kind of definition, where physical risks are those risks resulting where you have nature loss and you might have a loss of those services that Carter mentioned, things like soil quality that businesses are depending on. And some of that might be very acute, might happen very rapidly because of an oil spill, or happen over time because of more gradual pesticide use or climate change. And then transition risks, which are just like for climate, risks that are emerging because markets, policies, technology are evolving, and a business might be out of sync with that evolution. And then finally, I think what's really interesting in nature is thinking about systemic risks really importantly. So because we know ecosystems can tip to a new stable state, that might be less good for all of us, and for business too. We think about those kinds of systemic risks as well as risks in the financial system itself. And what's been interesting is to have that recognition. That's not just an issue for central banks. It's not just an issue for the financial supervisors. It's actually for individual businesses and financial institutions also. Coming back to Carter's point about things being connected, we need to, within an individual entity's interest, to understand what might be at the cusp of being a major tipping point.
Yeah, I think this emphasis on disclosure, both in the Taskforce for Climate-Related Financial Disclosure and TNFD, is really interesting, because what we ask companies to do in their annual reports, 10Ks, 10Qs, that the SEC and SEC equivalents around the world ask, is to identify sort of how the business is doing, its revenues, its assets, all those sorts of things. We also ask them to say, what are the risks to the business? But until recently, those risks have not really been related to climate and nature, and yet these can be huge risks. Like if you can't get water in your Coca-Cola, or you can't pollinate and you're an almond grower, this is a problem. I know that TNFD has done a couple of reports or worked, partnered with others to kind of assess the scale of these risks,
Yes.
both in a couple of sectors, agriculture and a few other sectors. I wonder, could you tell us a little bit about some of those findings?
Yeah, absolutely. Yeah, no, we've started to create a database of case studies. I'm going to do more and more work on this with partners, and it's live on our website. So do encourage people can submit their own case studies. But the first set we did were with Bloomberg NEF. We looked at 10 case studies which showed that financial importance of a business understanding and managing, how it impacts and depends on nature, and then how that may create risks to them. So a couple of maybe topical examples. Tesla, I find an interesting one, because Tesla's always interesting, but also where climate and nature risks are compounding each other. So climate change was a contributor to declining groundwater levels. And it was one of, Tesla had downplayed the threat of those declining groundwater levels. And then there was a big delay in completion of permission for a major factory, which cost them nearly $6 billion for a factory in Berlin due to the delays. And because there was a stakeholder complaint that they weren't sufficiently considering that. And there are many others. There's one around Bernard Matthews, which is a poultry producer, which had inadequate biosecurity. So those measures that would have that then enabled avian influenza to enter and spread through its supply chain. So that cost tens of millions of pounds in lost sales. There's another really interesting one. The border between climate and nature is always a bit fuzzy, which I think is interesting. But Pacific Gas and Electricity Company in California had a huge share price fall after a series of forest fires that were started by sparking lines. And that, yes, it's sort of related to climate because of increasing forest fires, but also they poorly maintained the infrastructure and they weren't managing the ecosystem. So that led to huge litigation settlements, credit rating downgrades, and ultimately, I think the loss of the boss. So, lost his job. So there are these examples we're trying to bring at the entity level, building from what Carter laid out at the more sector or regional or thematic level, to make it real for individual businesses and, of course, their investors or insurers or those lending to them in banks.
Before we turn to Raviv and insurance and other things like that, I want to ask you, from TNFD's perspective and your perspective, what would you like to see happen in your ideal world? How would this get more incorporated into economic systems? Who are the key actors that need to understand this, play a role in this? What's kind of the end game that you're working towards?
Well, this is where I might need my own caveat. So there's me as a TNFD, but what I'm doing within TNFD, for that, I hope to have even more widespread adoption. We have 500 organizations now adopting TNFD. We've seen about 70 reports. We're covering a huge part, I think 62 of the 77 sectors that exist in about 17 trillion in assets under management. So I'd like to see that continue to grow so we get more and more.
And that means they're following your guidelines,
the
recommendation.
The recommendations. Yeah, there are many, many more. So it's interesting. We have it's still quite small uptake of the disclosures in the US, but I can also see who's downloading our guidance. So they're doing that assessment internally and not disclosing it. And the US is often in the top 3 countries. So there's using our guidance for the assessment and risk management, which might be internal. There's also then using the disclosure recommendations. But more broadly beyond TNFD, of course, I think that it's not just for the private sector action. I think we need to see action also with policy signals and with not only central banks and supervisors, but governments also creating the enabling conditions for what's needed.
Mm-hmm. Yeah, so what that looks like, I imagine, is things like SEC and SEC equivalents requiring this disclosure in their reporting systems. I know, we've had attempts to do this on climate-related financial disclosures that have worked in some countries, not worked in others, but something like that is kind of what we're talking about, right?
Yeah, and in TNFD, we are very clear. We're not, advocating for what we put out to be mandatory. We're really driving the voluntary adoption, and so that means, and it worked well for TCFD, having that market experience and understanding and maturity, and seeing it really not just as a compliance exercise for meeting a regulation, but really understanding it's central to my strategy, central to my risk management, my business performance. So that's what we're focused on driving. But of course, the glide path is still there, the experience with TCFD, and one really important priority for us now, because we're a set recommendations of framework, we're not a standard setter. With the market, telling the market what they're recommending the market should do, because it's sensible. But we're now working with the standard setters, most importantly, the International Sustainability Standards Board, the ISSB, and the Global Reporting Initiative, who are the big global standard setters, to help them learn from what we've done and to update existing standards or to build new standards in the next couple of years.
Great. Yeah, and I should point out that if you people want to ask questions, they can submit them on the chat, and we'll try and leave some time for Q&A later. It seems to me that for incorporation of these risks deeply into our economic system, we do need some of these regulators, SEC and others, but there are other entities that have been created as a way of dealing with financial risk in our systems that also need to pay attention. 2 of the most important, in my view, are the insurance companies as well as the credit rating agencies. Insurance companies we're all familiar with. They're there to manage risk. What few people realize is they also help understand and price risk. So they have a number of different roles. Credit rating agencies, generally speaking, the way they assess the credit rating of a company or a government or a bond issuance is they look at, will the person borrowing money be able to pay it back? And what do we think are the chances that they'll be able to pay it back? They have traditionally looked at risk in that very, very narrow financial system. I know a lot of the major credit rating agencies, Standard & Poor's, Moody's, Fitch, have all said they're thinking about climate and climate risk, not so much nature risk quite yet, but I imagine that's coming. I wanted to turn to you, Raviv, who've worked a lot with the insurance industry and with other aspects of the financial system, to see if you could talk to us a little bit about what you see is happening, given what Carter and Emily have talked about in the work of TNFD and groups like Pollination and others. What do you see happening? Is the change coming? Is it coming fast enough? What would you like to see happen going forward? And what's the role of your group in all of this?
Thanks, Ricardo. Happy to. And just to build off what Carter and Emily already expressed, to make the risk more real, there was a study that came out of Vivid Economics where they show that if nature risk left unmitigated, we are looking at up to 30% drop in net present value for specific sectors, for specific companies, for specific markets between now and 2030, right? So this is not some net zero target, like a 2050 goal that we have time to start debate and wait for the regulators and wait for the public sector and wait for governments. This is here and now, and this is gonna wreak havoc on physical supply chains. And we're already seeing this. If you're following some of the price of commodities last summer, from coffee to olive oil So oranges, we're seeing price of commodities going up because of natural disasters. So we're starting to see this in supply chains. And when we talk about nature risks, yes, they are related to climate risks, but they're also different. They're local, and they could turn into systemic risks. So in addition to what we know about climate risks, droughts, fires, floods, we're talking about food supply chain disruptions. We're talking about soil degradation. We're talking about zoonotic diseases. I live in Colorado. Last summer, we had to call millions of chickens. I just read that USDA ordered tests for bird flu for 16 states for the nation's milk supply. This is all bubbling real nature risks related to climate, but also specific to nature that we are starting to see. And coming back to the insurance companies, when we think about the traditional role of insurance, you said that, yes, there are risk managers, but they're also risk carriers. And I think the number out there is over $150 billion that the insurance companies will have to pay in losses on an ongoing annual basis moving forward from natural disasters. So it's their job to not just understand nature risk, but also to work with the private sectors to try and mitigate some of the climate risk using nature. So we'll talk more about risk and opportunities. It's not just risks. Typically, where you see risk, there are also opportunities to engineer with nature, to work with nature. I'll just give a few examples that we're looking at. We're doing right now work on nitrogen risk insurance in the Mississippi River. And this is systemic water risk that it's building in the Mississippi River. There is the hypoxic area in the Gulf of Mexico. It's killing fisheries, it's killing the shrimp industries, it's polluting the water. It's the cause for colon cancer. I think there is not enough talks on the link between nature risks and human health when it comes to animal proteins, when it comes to agriculture.
Just on that, Raviv, just to clarify, what you mean is that with the use of nitrogen and phosphorus and other basically fertilizers up and down the Mississippi, that gets into the water, that collects down at the Gulf of Mexico, that creates algal blooms, which essentially, you know, can become toxic. But when they die, they use up all the oxygen in the water, which means a few things other than jellyfish can live in the water. Those are the hypoxic zones, and every year at the end of the Mississippi, there's a huge hypoxic zone the size of several states, which obviously hurts fisheries, it hurts shrimp production and other things. So just to give some context on that.
Correct. So when we look at those businesses, those food and beverage companies, water treatment facilities, fisheries that operate on the Mississippi River, they are now becoming operational risks. Those businesses carry insurance. They pay every year to really treat nitrogen in the water. So now comes the opportunity, which is we are in the process of actually bringing a nitrogen risk insurance product to the Mississippi River with working with Iowa State University, working with the Walton Foundation. And this is a program that we've seen being very successful in Australia, in fact, where farmers can reduce levels of nitrogens, saving on input. So that's a win for the farmers. Insurance companies and brokers can make money, right, on the premiums, and we can save the Great Barrier Reef from nitrogen runoffs. So now we're doing not just nature risk, but also the opportunity and looking at the economic impact and the economic opportunity to bring together cross sectors to reduce nitrogen risk with the insurance industry. The same idea can work for the Mississippi River. So one example of, again, risk and opportunity, where once you start looking at the economics, and I think we need to do more work, not just on the environmental science, but really connect environmental scientists with environmental economists. That's key to understand value at risk and the opportunity. So put a dollar number on that. Another example, we've been asked by an insurance broker to design and build a parametric insurance. And a parametric means there is a quantifying event where you can automate some payouts, build an insurance product for sargassum risk for the tourism industry in the coast of Mexico. So just to give you an idea, every year, and if you've been to Cancun or one of the hotels, in Mexico, the problem, massive sargassum, that's the seaweed that kind of floods the beaches. It sits there, it rottens, it stinks, it emits methane, it suffocates the life out of other organisms. So just to clean 1 kilometer of beach costs between $800,000 to $1.5 million for the tourism industry. What if we could start to mitigate this? What if we could start prepare for this? This, by the way, occupies huge area that we can see from space, the ocean. We can now starting to use technologies to really prepare for this, distribute the payouts, and there is an entire economy, in fact, around that seaweed, because we can reduce methane reduction. So we can do methane reductions, meaning we can apply some financing, get some credits. There is also a company, I think, called Carbon Wave that knows how to recycle that and create all sorts of products. Here's another example of nature risk and opportunity to work together with the insurance industry and the tourism industry.
Yeah, and I think, you know, the other thing people don't realize about the insurance industry is that it's also one of the world's biggest investors. So all those premiums people pay go into somewhere, they're invested in order to be able to pay off, you know, if some of the risks that are happening happen. The other thing people don't realize about the insurance industry, and this can become important going forward, is that, you know, in many cases, so take, you know, climate risks, storms in Florida or what have you. In most cases, the insurance for that is written on an annual basis. So every year, the insurers can decide whether they want to cover it or not cover it, and then they can leave the next year and say, nope, we're no longer covering that. And we've seen that happen now in places like Florida and California around wildfire and things like that. So, you know, ultimately, yeah, insurance is at risk and they carry some of that risk, but they also are not the ultimate holders of a lot of this risk, right? Because at the end of the day, it's going to end up being maybe governments and the public at large that's going to bear some of those costs, and companies that will bear some of those costs. So, you know, how do we work with the insurance industry to understand that, to fix that, and to deal with some of those problems? And how do we involve the insurance industry with the trillions of dollars they manage in investments to take advantage of some of these opportunities and push in this direction? Are you seeing that happen?
And just to add to this, I think you make a really great point. I think the number out there is close to 40 million homes in the US which are uninsured. So that's putting a huge burden on real estate market, of course, the economy. You cannot get insurance, you cannot get a mortgage. When we look at areas such as California, Colorado, lots of it is wildfire risks. Then again, on the opportunity side, we've seen, I think that study came from WTW, that if we can practice ecological forestry and do prescribed burns and do thinning and build, you know, fungal content and moisture in the soil, we can reduce wildfire risk up to 40%. So what if, for example, insurance companies can work with local communities, with farmers, with other local players to really practice ecological forestry, which is good for nature, but also good for reducing wildfire risk, and make some of the commercial and residential insurance policies more affordable. Here is another example. And you talked about what we're seeing from the insurance industry. Yes, I think it's also matters of regulation. In Europe, at least, we're starting to see regulation that forces insurance companies to invest back in nature from the balance sheet. Not sure if we're going to see something like that anytime soon in the US, but it's the idea. It's a fascinating field, by the way. There is lots of work being done by UNFFI. There is a group called PSI, Principles for Sustainable Insurance, that gathers 40 of the largest insurance companies to do what's known as eco-DRR, or ecological disaster risk reductions. Carter talked about mangroves. We can quantify the benefits. The same Santa Cruz study, Carter, you know that, actually showed that during Hurricane Sandy, salt marshes provided over $600 million of benefits in mitigating some of the storm damage. So the science is there, and honestly, the data is also there. Don't let anyone tell you that there's not enough data. I think we are drowning in data, starving for insights. how do we take this data and link it to the risk science and build risk models and, you know, create insurance products? That's a different question, which we need insurance industry for. But even Emily from TNFD will tell you that the data is there. I do not buy that there is not enough data.
Yeah, no, many of the problems we face are not because we don't have enough data. It happens to be a whole lot of other things that stop us. Great. So we've kind of covered the landscape except for a few things, and I think, Claire, I'd love to turn to you to talk about a few other angles to this. You know, you work at the New York Fed. The New York Fed is essentially looking at monetary policy and other things like that, but also, and this is very important, you know, how to get underserved communities to participate more fully in the economic system, and that means both opportunities, but also risks, right? You know, some of these communities will face greater risks going forward. So I wanted to ask you, and I don't know if you can provide any color on this, but, you know, at the end of the day, we have said that insurers carry some of that risk, but some of that risk ultimately will fall on the risk bearer of last resort in most places, which is governments, and to some extent, this can be a systemic risk, which is something that the Fed cares a lot about and the New York Fed thinks a lot about. So I wonder if you could touch on those two things, right? The role of a group like the Fed, how it's thinking about these risks. Is it thinking about these risks? And secondly, you know, in particular with your work at the New York Fed, how you're trying to look at how these risks affect underserved communities in the US.
Those are also big questions, and I'll take kind of bite-sized answers. First, I'll just say that, you know, I sit in our community development area, so just want to be very transparent about kind of the scope of what I can talk about comfortably. You know, our unit was created, it's a byproduct of the Community Reinvestment Act of 1977, which is part of a whole host of legislation, was really intended to combat redlining and ensure that regulated financial institutions provide credit and investment in communities where they collect deposits. And so that legislation, that act, has had its own life with various chapters. And I would just fast forward to the present and say that our role in serving underserved communities is to be a connector and I would call a data translator. So we said that we've just admitted that we have enough data, and I agree with that. I concur with that consensus. I don't think that we have enough dot connectors and translators. And so that is a big function for our team in our district, and we have you know, sister offices across the country. So just to, you know, make this concrete, you know, yes, you're completely right. When the rest of the country or the world gets a cold, you know, low-income underserved communities get severe pneumonia, right? And I think that when we think about, as I've heard the wonderful co-panelists describe today, the various nature-based risks, I think it's really important to start with the premise that underserved communities are not starting in the same place as other areas. These are communities that have been polluted. These are communities that have had disinvestment. These are communities that are at a already higher risk for diseases and comorbidities. And so when we think about, you know, something as recent as COVID-19, you know, who bore the greatest fatalities, you know, in the early waves of that disease. So, you know, Americans are very resilient, and that's a wonderful attribute. But sometimes something as recent as, you know, a global pandemic that happened only, you know, 4 years ago seems like ancient history. And I think that we would be remiss if we didn't learn lessons from that. And as well as the chronic conditions that, you know, underserved communities are already contending with, let alone the risks that have been described in this webinar. So I just want to kind of lay that out. I would also say, though, when we connect dots, part of our function is to really connect what might be described as strange bedfellows. So if you think about kind of the core responsibilities of an organization like the Fed, of course, we care about primarily financial inclusion, and that means access to financial services, it means access to opportunities for employment and economic mobility. But, I think increasingly we realize that, access to healthcare, access to safe and sustainable housing is a critical need. And, this has been much of the discussion in 2024. I don't think that the housing situation in America is an issue area that is going to go away quickly. But when we think about this as it relates to underserved communities and creating something like affordable housing, how are we making sure that all of the insights that we described today on this webinar, the need for mangroves, the need for green space, cushion to mitigate the need for controlled burns, is something that we're able to fund. So I think connecting the dots as you're describing, Ricardo, is really important. When we think ultimately a kind of who holds the bag, you're right that it's government. It can be government in the form of Medicaid, right? What are Medicaid costs going to be if we increase risks, particularly as they relate to low income underserved communities? Could also be insurers. So I think we kind of have to think. So that puts us in a position, I'll just say, in our team where we are thinking about health a lot. We're thinking about connectivity a lot, and we're thinking about other stakeholders. So for sure, financial institutions, but it is also, insurers, both health insurers as well as those who handle physical risks. So I'll stop there. I will say that the Fed is thinking about risks. Certainly, we are in the business of risk and understanding, getting our arms around risk. I think folks are aware of the broader work that has happened at the Fed with respect to insurance. It is a topic of interest because the U.S. housing market is a major market. My co-panelists have talked about the exposure of housing and the challenges in insuring housing. I think the other flip side, though, that I'll just say with the massive insurance topic is resilience. Right? What can you do to make housing and other assets more resilient? And I do think that insurers and reinsurers can play a massive role in that. So I'll stop there. Hope that answers those two big topics.
Yeah, and I'm going to turn to questions that are coming in, and if anybody has any other questions, please write them in the chat or send us a note, and we'll try to get to them. I know we're getting close to time. I know some panelists can stick around a little bit longer than 1 p.m. Eastern. So those of you who can, we will. And if there's interest and there continues to be questions, we will continue to stick around, and I can certainly stick around even longer than that. But before we jump to questions, I know, Claire, that the New York Fed did bring together people from insurance industry and others to think about at least climate risk. Can you tell us about the thinking there and where you see that work going?
I think this really goes to the earlier point of this isn't just kind of a single entity's issue, right? There's risk that's held collectively and needs to probably be managed collectively in one fashion or another. And so we worked with two local nonprofit organizations and brought together folks who are in the insurance industry, but who are also municipal leaders and others who really, I think, have a stake in understanding the risk and also are ultimately going to kind of hold the risk and bear a big part of the expense if it is not managed well. So the idea was, municipal governments they wear a lot of hats, and they're on short-ish time cycles, because of our changes in leadership. But the city of New York, where I fortunately work, if you hear sirens, I am authentically in Manhattan today. It can be quite large, and so Superstorm Sandy was referenced earlier, a massive event that struck our region. It certainly affected our municipal leadership. I think we've learned a lot since that point, but this workshop was really designed to say, how do we innovate? Can we launch some pilots? Where are there opportunities to understand where the risk lies? Who needs to coordinate? Which agencies need to talk to each other? And to recognize that, look, if you don't get ahead of it, your tax revenue is going to decline, and you can easily get into a doom loop. Now, on the inverse and the flip side of that is, if you can use resources well, whether they come from federal allocations, if you can deploy infrastructure monies, you can pair them with private financing, insurance money, and other pockets, you can actually maybe invest in assets that will generate a positive return, will get you a better credit rating, will crowd financing and investment into your municipality and make it really a place that is attractive for residents and others, tourists and others to visit. So that's kind of the idea, was let's get into the positive loop and not the doom.
And that's really points to one of the really important strengths that the New York Fed and the Fed system more generally has, is its role as a convener and bringing different groups together to think about some of these big issues. So let's turn to some of the questions that are out there. We have a couple of questions in the chat. Please put some more if you want us to answer them. The first one we have coming in is from Ned Abelson, and it says, in the current U.S. political climate, seems very unlikely the federal government will provide any leadership regarding these issues. My impression is that the commercial insurance industry has become the default leader due to their loss experience, and perhaps in part due to the leadership from organizations like Insure. What do you think? Where will the push for this come from in the next few years? Anybody want to jump in?
I would just say that, at least I hope, and I'm curious to hear the other panelists, that nature is a more bipartisan topic than climate and carbon, because we can all experience the systemic destruction of nature and the impact on our life. So if we can agree on that, maybe not all hope is lost for the next few years for the administration to really take action.
Yeah, I completely agree with that. And in my past life working in an NGO, and after that, I think we haven't seen as much of a drop in biodiversity funding and support as you might expect, when administrations have changed or policies have changed. So I agree with you, Raviv. I'm hopeful about that. But I would also add to that question, I do think there will be more leadership from businesses, because I think, as we've been discussing, these risks are already manifesting. Like, climate change is actually happening now, as we're seeing with some of the insurers pulling out of states like California, Louisiana, Florida, as you already mentioned, the loss of pollinators that we discussed earlier. So I think we're going to see businesses starting to take action, not because it's filling a void in leadership, but because they have to, as we increasingly lose nature and experience the impacts of climate change.
Yeah, I agree with Carter, and I found the emphasis on insurance in this panel very interesting, very timely, because I have to speak on a panel tomorrow about insurance, and I was feeling ignorant, but now I've been soaking up all the facts. But what I see through those around TNFD is there's also a lot of interest from other types of big institutional investors, so sovereign wealth funds, pension funds, those who are thinking on a very long-term time horizon about their returns and may be invested across the economy and not easily able to shift out. And so these risks that are manifesting themselves across sectors, they have to think actively about managing. So I think the leadership, it's interesting that there's been a focus on insurance, also come from other types of big institutional investor. I'm hopeful of that leadership, and then, like you said, Carter, businesses that are in sectors which have these really high dependencies or significant impacts, wanting to manage them for the physical risks that they're already manifesting. And I think that's a sad reflection of the realities of how far we've pushed things, because these tipping points aren't theoretical at local scales, they're already happening. You mentioned some of the water examples. So they're already seeing disruption in their supply chains, and we're coming to the point where you can't keep shifting around. I mean, there's not that much left to shift to if you're getting your supply from some location and there's disruption. But yeah, that's where I'm seeing. And, you know, it was interesting when I was working on the descriptor review, I said to Parth, you know, what should I do next? Because I was sitting in the UK Treasury, should I stay in government or move into the private sector? And thinking that that is the reality, that actually for this period, the private sector has been moving very rapidly and leading. And why is that? I think it's a manifestation of the disruption in supply chains.
Yeah, and I mean, heck, if the prospect that we may live in a world with less or no chocolate doesn't get you up in the morning, then I don't know.
Coffee.
I don't know what does. Or coffee. No Jesus.
Starbucks, anyone?
Shoot me now. So I do think that businesses are taking up the mantle to some degree, and they will have to take up the mantle. I also do think that government is not just the U.S. government, but other governments are thinking about this in different ways. And I think there's potential for a lot of things to come out of Europe and Asia and Latin America and Africa on thinking around this. So, whether it shifts just to the public sector or whether it shifts to other places, I think it'll be interesting. And, most businesses in the U.S. also, or many of the biggest, also work in Europe and also work in other places where they will have to face some of these restrictions. So I think it's going to be interesting to see how that interplay is. And, in any major environmental change, it's really a dance between government, business, and public opinion. And when one steps out of the game or moves to the side of the game, then others tend to come in and fill in the spots. So it'll be interesting to see how that goes. Let's turn to another question we have, and we'll try to wrap this up by 1:15 at the latest. But one question goes, people and companies care about what they own and can control. Nature seems to be the victim of the tragedy of the commons scenario. From a private sector finance perspective, how do you actually make money? It's very hard to monetize avoided costs. With respect to insurers and a growing reluctance to cover climate nature risks, I was recently told that when the money men are running away, there's no money to be made. What do people think? Do people feel that way? Is there money to be made? Maybe Carter, you can kick us off. I mean, some of the nature-based solutions you work with companies on.
Yeah.
What are you thinking?
Totally. I mean, I think this question is like encapsulates our sustainability challenge, right? Like long-term thinking versus short-term thinking in some respects. But yeah, I mean, I think that's one thing we focus on a lot at Pollination, because we recognize that this idea of avoided cost and some of the longer term impacts can be harder to motivate organizations. Although I think, Emily, you made a great point earlier about targeting some of these institutions and investment institutions that have longer time horizons, like pension funds, for example. But I do think to your question, Ricardo, things like nature-based solutions that can deliver revenue through carbon credits, for example. People are increasingly looking at biodiversity credits as well. I think that can be really important. There's also opportunities with regenerative agriculture, for example, that can, if you can finance the transition to regenerative agriculture, can hopefully drive higher profitability and can become more appealing from a financial perspective for producers and for others in the supply chain. I mean, we are, as an organization, we also have a joint venture with HSBC, and we're investing in opportunities like regenerative agriculture, sustainable forestry that deliver commercial level returns and also deliver outcomes for biodiversity and for climate change. So we believe you can do that. We also, are investing directly in projects, nature-based solutions projects, like a big mangrove project in Asia. And also, I think it's not just directly investing in nature, but there are opportunities to invest in businesses that focus on biodiversity. And we're doing that. We're hopefully going to release soon a new fund that's going to deliver in biodiversity focused businesses. And also nature tech is a big space out there, like investing in nature tech that can support measurement of impacts and dependencies on nature or risks too. So I think there's a lot of opportunities that can deliver returns that are important enablers of the ecosystem, even if sometimes they're not direct investments in restoration or conservation on the ground, but can enable conservation and restoration of nature more broadly to prevent and manage some of these risks.
Can I add
So
to
what
it?
you're saying is that not all the money men are running away. There are
Yeah.
many people running into the breach to see how they can work. Yeah,
Yeah.
go ahead, Ravi.
Yeah, not only all the money people running away, we're actually seeing pressure from pension funds, from retail investors that thinking in the 20, 30 years horizon to actually deploy money in natural capital. I was in New York back in the summer. There was a natural capital investment forums. You talk to companies such as Mirova, Manulife, other companies that deploying natural capital. They would talk to you about even low double-digit returns. I don't think there's any expectations to go and invest in natural capital and expect like VC returns. But if we could think of investing in nature more like infrastructure, the same way we are thinking of investing in roads and bridges, the short answer is yes, there is money to be made. And by the way, that money is not from carbon credits. I don't want to go too deep into that kind of rabbit hole, but I think the writing was on the wall a few years ago, and we've seen what happened to voluntary carbon markets. We are also investors in nature tech, and that money is just looking at the unit economics. If we can find more sustainable ways, alternative materials, alternative animal proteins, sustainability is just good business. We made investment in that space. We see good investment in that space. Last comment on the tragedy of the common. I think that that tragedy is probably more around carbon, where all carbon goes to the atmosphere. So people think like, okay, if we're not doing enough, this is not just my problem. Everyone is emitting carbon to the atmosphere. Nature, in fact, is more local. And when you talk to the big, at least food and egg companies, the Nestle's, the PepsiCo's, the General Mills, they are well aware of the risks coming to supply chains and working with companies on the ground to mitigate this. It's not so much about avoided cost. I think it's more about building resilience in order to minimize losses from future climate events.
Mm. Yeah, I know, Claire, you have to jump off in a minute or two, but there is one question for you there from Jake Fabian. I don't know if we have a minute or two to answer it. And that is that I have a question regarding the panel's thoughts on systemic risks within lower SES communities and the environmental risks that they face. As Claire mentioned, these communities are not starting from the same place as other communities, either from histories of redlining, historic underinvestment. How does the panel think about the concept of blue lining in these communities, where lenders and other financial institutions might not be as willing to participate or provide financial services to the areas that are faced with these heightened environmental risks? It seems like the solution to addressing many of these communities' issues is more money. So how can we think about alleviating these types of credit constraints that are intrinsically linked with environmental risk? Any thought from you, Claire, before?
I'm happy to hop in since, and I appreciate the question, because I think this topic of blue lining has been getting some I think, well-deserved attention. I think, look, I think it's like anything that we've talked about here today. Who ultimately is holding the risk? Who ultimately, holds the opportunity? And so I think as we think about fortifying communities, as we think about nature investments, there are opportunities, and I think often there may be opportunities with local governments as well as local financial institutions that are looking at their portfolios and saying kind of what's the future of my balance sheet, what's the future of my consumer base, can we co-invest to generate kind of a positive outcome. I think we've seen this in innovations that have, I think they're in their early stages, infancy. Some interesting pilots with insurance, providers who are investing with local nonprofits. There's a pilot that was launched in New York City. It was a parametric insurance pilot, but it was, to say, hey, like, look, we know that there can be a really long gap between when an event happens, a risk event happens, and when any monies, public or otherwise, grants are available. And so communities, particularly underserved communities, Ricardo, as you noted, are like going to have to dip into their own pockets, which are limited. Parametric insurance, which Raviv you mentioned earlier, can be used, if a certain, number of inches of rainfall, for example, fall within a contained, time period, there would be a payout to people living in a confined area. That provides liquidity to those families, to those households, to kind of help them get back on their feet. That can have a multiplier effect in communities as they are able to kind of go about their days, make purchases, et cetera. So, I think, in the broader context of, I think this question as I'm reading it is, how do we prevent, places that when we project out 30 years, they're looking like they're going to, get hit multiple times. I think that information is power. So if you don't know that the risk exists, which is kind of what our team has been trying to do, is sort of make risk information translated and understood, and in the hands of local stakeholders. I think that's step one. Step two is kind of who can benefit from getting together and devising a solution. And that could be a combination, and it most likely will need to be a combination of private and public stakeholders. But I don't think that we're, certainly philanthropy has a role, but it's not going to be on the scale of what's going to be needed. It may be able to seed some early, early investments in pilots. But my hope also, and I'll conclude with this, is like, I want there to be a better information exchange about the pilots that are existing across the country, because a lot of really interesting work is being done. And I think that the doers are often so busy doing that they don't kind of sift up, and there aren't, I think, enough showcases for what's working, particularly in the realm of kind of what's happening in underserved communities.
Great, thank you, Claire, and thank
Thanks
you for
question.
joining.
Yeah,
We have a few more questions. I'm going to read a few of them out loud, and then anybody who wants to can jump in and try and answer them before we close up here. Before 1:15. So we have a question from Alex on Tebi. It said, media has not done a good job on connecting the dots for risk. Can TNFD, and maybe Emily left, but can TNFD or anybody else, I'd open it, use the media to raise awareness of risks? Would some of the voluntary listeners be media worthy? Secondly, we have a question that came in via email that sort of says, let me pull it up. Given the European Central Bank's incorporation of climate risks into monetary policies, what steps can the US Federal Reserve take to integrate similar measures while remaining aligned with its dual mandate of price stability and maximum employment? Claire's probably glad she had to jump on that one. Then can you comment on regarding the incoming administration's comments on the dismantling or defunding of EPA and NOAA? And finally, what do you see as the role for public-private partnerships and innovative financing for nature, particularly in developing country context? How can these entities the panelists represent help cultivate these relationships through research and work outputs? So we'll go with those. There's a few more coming in, but let's stick with those if anybody wants to jump in. So media, European Central Bank, defunding of EPA and NOAA, or public-private partnerships. Anybody want to jump in?
I mean, I'll jump in, Ricardo, on the public-private partnerships. And I think one of the things we're seeing, we're working on a big project that was announced recently that's going to focus in Africa, and it will be a public-private partnership of a lot of different entities, private and public sector, and public and private sector sources of capital. But we see this in other places where no one entity can necessarily pay for the transition to a regenerative landscape, for example, on their own. And so I think we're starting to see, especially as some companies coalesce around landscape approaches, which I think has been bolstered by the TNFD and the LEAP approach, which is encouraging companies to understand their local interface and interactions with nature. It's encouraging, I think it's helping to drive more landscape scale approaches where public and private sector actors are realizing in order to address aquifer depletion, for example, or in order to address the transition to regenerative agriculture at landscape scales, we have to have multiple sources of capital working together. And so I think we're starting to see more partnerships there, and it will require collective action of a lot of different entities who work together in a landscape, but also thinking differently about how we measure progress towards goals. A lot of the the goals that companies have set recently, are very company specific and don't necessarily encourage collective action. So we need to have like frameworks that incentivize that collective action and the development of outcomes that are going to be bigger than any one institution can achieve. And I think we're starting to see some really interesting examples of that.
Great. Unless Raviv, you want to take any of them, we will wrap this up.
Yeah, last comment on the public-private partnership. Totally agree with Carter. I think that's key. We're doing this with the nitrogen risk insurance on the Mississippi River, bringing together Iowa State, bringing together some of the food and beverage companies and fisheries and shrimps companies that operating in that space. Like I said, nature is very local, so it's key to do those public-private. On the just in general, I think it's all bundled on the defunding of EPA and NOAA and whatnot. I mean, my opinion is God help us if we need to wait for governments and regulations. We're not going to make it. I'm sorry to say, we're moving too slow. Nature cannot wait, which is at least for us, and I know Pollination is also focusing on that, and TNFD, the key is engaging the private sector, leading with nature risk, and then bringing in, of course, the nature opportunity. But I personally wouldn't wait for governments. I think we need to go deeper and stronger with the private sector and deploy trillions of dollars in nature. When you look at financial flows right now, there is a UNEP FI report that came out that shows, I think the number is $7 trillion of negative nature financial flows compared to $200 billion of positive financial flows. Lots of it, I would go back to follow the money if we want to stand the chance of solving that.
Yeah, I would add public opinion to business because I think the two are very interrelated, and that will potentially address government. So agree with you on all. A big round of applause to the panelists who made it this far and the ones who left us a little earlier. Really appreciate their time. I'm going to put up some QR codes around IBIS if you want to find out more about the work of IBIS. But thanks so much, and let's hope that we can think bigger and better about risk if we can involve private sector and other actors in measuring and understanding this and pricing it. And I think, just leaving us with a thought that I think Claire raised the issue of resilience, which is very much tied to risk. I think we need to think about what that looks like. What does resilience mean from a natural and climate perspective? How does it get financed? Is it, as Ravi was saying, through infrastructure types scenarios? And how do we more incorporate these issues into our economic system? Because if it doesn't see it, if it has this blind spot, then we will continue to have this problem. But that's it for me. Thank you very much, panelists. Mark, do you want to say a last goodbye?
Yes, thank you, Ricardo, and to our panelists as well, and to all of you for participating. As Ricardo mentioned, if you haven't already done so, please sign up for our IBIS Alumni and Friends Network to stay in the loop on more content ahead, like network exclusive events with faculty, and please email me on what topics you'd like to see us cover in the future. You'll also be signed up for our monthly newsletter, the IBIS Insider. Jess will drop the link for the sign up in the chat. Thank you, Jess. And finally, we're also hosting a Climate Careers Exploration Day on February 7th and are looking for additional potential employers as well as alumni participants to attend and provide informal chats with students about their climate-related careers. Please let us know if you're interested. Thank you again, and have a great day, everyone.
Okay, thank you, everyone.
Thanks so much.